Hello everyone, my name is Anastasia Winiskandar and I represent my team to present our paper entitled Earning Management, Income Volatility, and Cost of Debt. The first section in this paper is Introduction. In developing its business, companies need funding sources, both from internal and external parties. If internal funding is not sufficient for the company's needs, external funding can be done by seeking bank loans or corporate bonds. Companies that present financial information with lower quality tend to have a higher cost of debt than companies with better quality financial information. To run their business, company will do earning management. There are several ways to do earning management, one of which is income smoothing. Companies with a higher level of income smoothing show a lower cost of debt. Another factor that must be considered is income volatility. Income volatility increases the cost of debt. Many studies have been conducted on the relationship between earnings management and the cost of debt, with either positive or negative results. And the test results of prior literature on income volatility show positive results. The first theory that we use in our paper is pecking order theory. This theory states that companies prefer to fund internally because they have a lower risk. The second option that can be selected is to seek funding through debt. And the last option is to seek additional capital by issuing new shares. Credit analysis theory explains what aspects a creditor should consider when he wants to provide funding to prospective borrowers, such as characteristic, capacity, capital, condition, and collateral. Cost of debt is the rate of return desired by creditors when providing funding to the company. The level of cost of debt itself can be influenced by several factors. Liang Ricci in 2016, through his research, found that earning management are negatively related to the cost of debt. Income smoothing can be a significant trigger to the cost of debt capital. With the higher the income smoothing of the company, the lower of cost of debt capital, as seen from the lower bond yields. Based on the explanation above, the first hypothesis in this study, namely, earning management has a negative effect on cost of debt. Government in 2018 found that the volatility of pre-tax income was positively and significantly related to cost of debt. Companies with high income volatility are considered to have a large credit risk, so they bear a greater cost of debt. Dhaliwal in 2017 also confirmed that changes in earnings before tax are positively related to company risk. Based on the explanation above, the hypothesis in this study, namely, income volatility has a positive effect on cost of debt. Control variables that used in this study are leverage, size, PPE, and cash holding. Our sample is public firms listed on the Indonesia Stock Exchange, except for firms that are included in the financial sector, holding companies, and also firms that use the final tax rate, which was categorized as mining, infrastructure, real estate, construction, utility, and transportation sector during the 2014 until 2018 period. The formula for calculating the cost of debt is interest expense for 1 year divided by average long-term debt plus short-term borrowing plus short-term of long-term debt. The proxy earning management discretionary accrual measured by the performance-adjusted modified Jones model by Kothari in 2005 are used. Income volatility is calculated as the standard deviation of annual pre-tax income scaled by lakh total assets measured over a 3-year period. We use static regression, and between pooled fixed effect and random effect, fixed effect is selected. However, the model contains heteroscedasticity, so that the weighted least square model is used to overcome this problem. The results of the weighted least square state that earning management has a negative effect on the cost of debt, meaning that the higher the earning management, the lower the credit risk according to banks, so that the cost of debt is also lower. Therefore, first hypothesis is accepted. High income volatility is disliked by creditors. It causes the level of corporate risk to be higher and the level of bank confidence decreases. Therefore, second hypothesis is accepted. The effect of leverage, size, and PPE on the cost of debt shows a significant negative relationship, meaning that the more value of leverage, size, and PPE a company owns, the less COD company get. The significant positive relationship shown by cash and COD. It means that the higher cash value the company has, the lower COD will be. Earning management are used to manipulate company profits in the financial statements presented. However, the results of this study indicate a significant negative relationship between earning management and COD. This means that the higher the company's earning management value, the smaller the COD given by creditor. This was a leak because Indonesian banks did not question the company's earning management activities, because in providing credit, the bank would refer to financial statements issued by the company. By performing earning management, it can be assumed that the company's revenue increased in value. Therefore, with increase in revenue reported by the company, the COD be smaller. The high income volatility, especially for the last 3 years, is not considered a good thing for companies applying for debt financing. Banking does not tolerate companies with high income volatility. In fact, banks provide a larger COD. Banking considers companies with high income volatility to be at risk of default. Volatility can be caused by the nature of the company, such as the agriculture sector is considered more volatile because it depends on economic and market conditions at that time. Therefore, banks also choose companies from certain sectors in providing funding. Research in Indonesia for period 2003 until 2011 found that bank loans were concentrated in the consumer and trade sector. In addition, banks also consider the company's financial performance. Companies with stable financial performance are considered profitable for the bank. Control variables, including leverage, size, PPE, and cash holding, showed significant results on the cost of debt. Indonesian banking views debt earned by companies as a concrete form of creditor trust in the company. Companies that have higher debt are considered to be trustworthy debtors, so they get lower COD. Banks prefer to provide credit to companies that have a good debt track record in the previous period. Companies with a large size value have a large asset value too. Investors are more concerned with larger companies and therefore may have a stronger reputation as debtors. In addition, the loan guarantee owned by the company is bigger because it has more assets. This causes creditors to charge a smaller COD. Loan guarantees in the form of marketable assets are often required by creditors, so that companies that have more tangible assets get lower COD because they are considered to have a low risk of default. Large cash holding in firms can reduce the risk of default so that banks reduce COD given to the companies. Firms that have large cash holding benefits greatly from credit risk assessment. Thank you.